So today is applying risk management to butterflies and credit spreads. This is the second week in our summer series on risk management and adjustments. The series next week, Wednesday, will be the final installment of that. This is for educational purposes today. And if you weren't here last week, you can go to YouTube, I believe, and get the recording. It'll get you up to speed on the risk management. Let's look at today. Here's an SPX one-year price chart. And when I looked at this maybe an hour ago, SPX was around 2470. And so basically, we're seeing the same story that we've seen for the last couple of years. The market has been trending higher. And, you know, we can see here, whatever you want to call it, the Trump rally or whatever, we've come from near the election, November, all the way through today. You're talking 9 months, right? 9 months, we've had quite a move, haven't we? And everybody's pretty excited about that. In 9 months, we've basically gone from 2083 to 2490, right? And you're talking a 400, you know, basically a 400-point move, and that translates into about a 19% move, 19% move in what, 8 or 9 months, which is unprecedented. So we're up 18%, or what did I say, 18% in 8 or 9 months, the continuing uptrending environment. The next thing I want to show is the VIX. This is a one-year price chart of VIX, and VIX is at 12. Again, last Thursday we had a big down move and the VIX popped up, but for the most part, over the last year, you know, VIX has been most of the time, right? Most of the time under 14. So that's been the environment not only the last year, but the last 3 years. And so with that as a fact, how the market's been the last 3 years, what types of strategies do you think you almost could close your eyes and put them on and you start getting your checks in every month? What types of strategies over the last 3 years, for the most part, I'm not saying there couldn't be some bumps, but what types of strategies over the last 3 years, general strategies, what do you think can make you look like a great trader? Cash secured puts, put credit spreads, bullish type, neutral to both directional verticals. As Jeff said, you know, we're wonderful, low volatility and basically bullishness. All right. So today we're going to talk about 2 strategies, but what I want to introduce or talk about a little bit is what makes some of these strategies work. What is the, I kind of want to talk about the foundation or the risk management template that I basically have been using since I started, that I came up with for the retail type trades. But what type of template do I think you can use to be successful no matter what the market's doing? And that's what we're going to talk about a little bit today. So before we get into the risk management, here's the example I'm going to use. And I'm just going to use an example. Is this the only way to do a put credit spread? No, but I'm going to give an example of a put credit spread. I'm going to give an example of a butterfly, and then we're going to talk about it in the context of this risk management template that I think properly applied, you can be successful in any market over time if you get good at the craft. So here's an example of an SPX put credit spread that I was looking at today, and 5 wide. So the example with SPX is at about 2470.91. The example that I'm going to use here to talk about put credit spreads is sell 1 SEP 22 2390 put and buy 1 SEP 22 2385 put. And here's the implied volatility of the short, 12.63, and the long is 12.85. And your further out of the money put is always going to be higher implied volatility in the SPX because that's how the volatility skew is. So in this example, let me just point a few things out. This is your expiration graph, this red line. The purple line is the graph, how the graph looks today, right? The duration is SEP, I'm using SEP 22, which is 37 days till expiration. So this particular example we're looking at today is about a 37-day put credit spread, and the SPX is at 2470.91. I'm selling the 2390 put, and I'm buying the 2385 put as a hedge, so we don't have unlimited risk on the downside. This is called a put credit spread, a vertical spread, yes, 5 wide. So I'm selling the 2390 put, buying the 2385 put. 5-point difference between the strikes in this particular example. I'm bringing in a credit of 60 cents. So my margin or risk on the trade is 440. And the way you calculate that is you just take the difference between the strikes, which is 5, or $500 for every 1 contract. And $500 less a credit of 60 cents will give you $440. So if I did this at a brokerage firm, for every 1 contract, I'd put up $440. So my maximum expiration yield is going to be 13.6%. The maximum expiration yield will be 13.6%. Hey, Dan, how did you get 13.6%? Well, if you take a $60 credit divided by risk of 440, about 13.6%, and that would be this yield up here, but that's at expiration in 37 days. And this put credit spread, we're in a, as of today, we're in a low volatility environment. Last Thursday, we were at a 16 volatility, which was higher. But if you look here, VIX is 12.05 as of today, August 16th. So your deltas are a little bit long, which is typical with a put credit spread, right? Again, the price of the underlying is here, and your short put is here out of the money, and I'm buying a further out of the money put. My gamma is minus 0.01. My theta gets some positive theta, and my vega is minus 6.83. And that just means that if the option volatility of my short and my long option were both to decrease by 1 point from where they're at, I would benefit theoretically of about $6.83 for every 1 contract. If the volatilities went up 1 point from where they're at, I would lose that. Why? Because again, remember, if I'm selling the 2390 puts and I'm buying the, you know what, I might have wrote, did I do this? Oh yeah, okay, I thought I made a typo. If I'm selling the 2390 puts and buying the 2385 puts, because the 2390 puts are closer to the price of the underlying than the 2385 puts, I'm selling more time premium in the 2390 puts than I'm buying in the 2385 puts. So if the option volatility increases, which it would if the price were going down, if SPX were going down, I would lose money from the volatility viewpoint because, again, I sold the one with most time premium. So if the volatility goes up, I'm losing more in my short option than I'm recouping in my long option. So we're selling more time premium than we're buying. So this is my example of a put credit spread that we're going to kind of analyze with my risk management template. Does everybody understand what the example I'm using here? Does everybody understand what I have here? Just at least I took a few minutes to explain what is the strategy I'm doing, where is it in SPX, and maybe some of you aren't familiar with the graph and just so the visuals you can understand. All right, now we'll get into some guidelines. We'll get into some guidelines. Now, there's a couple reasons I'm using a put credit spread instead of a call credit spread. What do you think those reasons are? Anybody take a guess? What are two reasons in the SPX that you could justify why am I using a put credit spread? So number one, the main one is over the last 4 or 5 years, unless you're in a Amazon rainforest with no internet, we've been going up, right? Number two, you can get a lot more room on the downside than you can the upside. So if you sell a 10 delta put on the downside, you can get a lot further out of the money on the downside given the same delta than you could the upside. Why? Because volatility skew. What does that mean? Out of the money puts are a lot higher volatility than the out of the money calls. So those are the two main reasons, right? From a volatility skew, well, it'd be close, but the point is when you're buying an out of the money call, your out of the money call is going to be a lower implied volatility than the one you're selling. In an out of the money put credit spread, the out of the money put you're selling is going to be a lower volatility than the one you're buying. So that goes against kind of your conventional thinking, but what makes up for it a little bit is that the implied volatilities in the puts are higher than the calls. But if you actually looked, and I don't want to get into this today because it's a different concept, the implied volatility of the spread, they might be close, right? If you looked at the implied volatility of the spread, because you could, but anyway, that's a much different, a little more advanced topic. So the net deltas of this are about 1, right? I mean, the delta of this spread for one contract, it's about 1 delta, yeah, long. So they're just subtracting the delta of your short put from your long put, so your short put's going to be a little bit higher delta. So let's get into the Dan's 4-step risk management process for any strategy. If the slide shows 0.99 delta, am I allowed by the laws of the Geneva Convention and the Illinois State Constitution to round it to 1? Yes or no? Yes, thank you. All right. Now, Dan's 4-step risk management process. Now, when I came from, let's see, what year was that? Let's say 2004. I left the trading environment pits at the Chicago Board Options Exchange, and I left like a lot of other people left, like Tom Sosnoff and John Nigerian and many others who I know or have worked with for a long time. When I left the trading pits and started teaching retail, here's what I noticed out there. And I think it's still in many ways prominent in the educational industry today, but it was even more prominent when I started, let's say 2004. You know, again, my whole universe from 1982 to 2004, 8-9 hours a day, we were specialists at the CBOE. That's why, you know, we ran a pit. I worked with the Nigerian brothers, who are on fast money, and we're specialists. So, and I did most of the teaching for our firm, and but when I came into the retail arena, I enjoyed, and one of the reasons that people left the pits was the business became electronic. Couple big things happened. Do you guys know what are the main we'll get a little history lesson here for you. What were the two main reasons that there was an exodus of traders around that 2003 to 2006, right? I mean, I think it was wonderful for the retail industry because you finally got some good option information out there. But do you know what was the exodus of John Najarian, Tom Sosnoff, myself, or a lot of people? What was the exodus of market makers or specialists? Why did they leave the pits? Why do you think they left the pits? Do you think they would have left the pits if there were still great money opportunities? Well, there were two big, so I think the big nail in the coffin, in my opinion, was the payment for order flow, right? Why a lot of, I'm giving my opinion again. We were one of the bigger specialist units at the CBOE, so I know, I'm aware of this. So what happened was payment for order. So we would get, all the stocks that we were the specialist in at the CBOE. We'd also have a broker in the pit that would, when orders would come in and do business, we'd have a broker in there, and we'd be able to charge whatever a buck a count, whatever it was for commissions, and that would help with the overhead, and we get the business in. But what happened in the early 2000s was, instead of the warden and the management at the prison running the prison, in my opinion, the prisoners took over. You say, Dan, what does that mean? What it means is that, so now all your brokerage firms, and it doesn't matter the brokerage, most of them were doing it, but let's say XYZ brokerage firm now goes to the CBOE and says, look it, we have all these customer orders, thousands of them, that we used to just send to the CBOE. But what we want to do now is, okay, CBOE, the American Stock Exchange in New York or the Philadelphia Exchange in Philadelphia, they want our business, right? XYZ brokerage firm and other. So what are you going to pay me? So now, and you could call it extortion, but I don't know, that's probably a strong word. It could be, a lot of people call it good business, right? But so they go to the CBOE, and the CBOE says, okay, we'll pay you 50 cents a contract just to get your business, right? But let me ask you a question. Do you think the CBOE paid that, or who do you think that they got to pay that? Who do you think they got to pay that? You have any idea? It's a tough question. Not the customer, you guys. No, you were beautiful. You guys are beautiful. They got the traders to pay for it, right? So let's say I worked with Mercury Trading, John and Pete Najarian, and they came to us and said, look it, okay, so I want you guys to pay for this order flow. So let me just say this. Bottom line is our overhead, right? Our overhead went from the commissions that we made just on the customers that would come in and do business would pay for our overhead. Now, our overhead went up 400, 500%. So we were spending $1 million or $2 million a year. I don't know what the number was, to these brokerage firms. So, again, let me give you a bad analogy. So let's say Stuart and Jeff and Dane are leasing some space for an Italian restaurant. They're serving Italian beefs with hot peppers, and the landlord raises the rent 4 or 5 times. Is that going to affect your bottom line? Yeah, I mean, the way we made money in the pit, we buy in the bid, sell in the offer, and that was one good part of it, but we had to take some risks. So they were basically that the electronic market was coming in, tightening up the markets. Anyways, so I think the traders bear the brunt of it, not the retail customer, right? Rates have gone down over the last 10 years, in case you guys didn't know, right? Rates have gone down over the last 10, 15 years. So I think it really got passed to the traders. So anyways, but when I came to the trading, there wasn't, in 2004, I don't know if any of you are old enough to remember the option education business in 2004. There were a couple firms doing it. There were 2 firms, big firms, doing most of it, right? There was Invest Tools, which is still around, and there was Optionetics. That was it, coming out of 2004. And I looked and I said, okay, first of all, I'm seeing, okay, here's these 2 big firms, right, spending, and here's the interesting things. These 2 firms were good. They spent more money on marketing than the stinking CBOE did. They had a lot of money behind them. But when I looked at their stuff, I said, you know what? Number one, it's pretty directional. I mean, there was some decent teaching, but it was, at least my observation of it, it was more directional, which to me is rough to make a living consistent directional. But number 2, besides being directional, they were you're learning from these live seminars, right, that you could go to for 3 days or 2 days, and maybe they had some other teaching, but it wasn't, to me, when I looked at this model and I said, well, how did we train our traders? How did we learn at the CBOE? How did people that lasted 20 years learn? Well, we weren't really directional. Most people at the CBOE didn't make a living by being directional, right? It was more pretty non-directional type stuff, understanding volatility and everything, but it was really good risk management. I mean, that was really what I noticed the difference. And so that's back then, when I started maybe 2004, that's basically the template of which hundreds of students, more than that, but a lot of students that have come through us that have applied, this basic process, as I will call it, that's where, I've seen a lot of success. And I still think the directional mold, not that you can't, again, I'm not saying the market's gone up for 4 years, right? But what I'm saying is the risk management strategy is the key. And so the first 4 steps, setup, step 1, profit target and max loss, number 2, step 3, when to adjust, step 4, how to adjust. Now, this is, if you look at setup, that's where, a lot of personality, this is the basic template that you'll see out there these days, or something like this, at least on, I think, what we do. But I mean, I think this is the successful template. Within there's a lot of flexibility, right? I mean, and what do I mean flexibility? With the market going up 4 years, you say, well, how could you be successful with an iron condor or a butterfly or a calendar if the market's going straight up? And the answer is at the setup. So there's a lot of flexibility. You're making them almost non-directional, but little tweaks, right? That you could start them based on the, and that's where there's a lot of flexibility. But the key is not the setup, right? The setup's going to help you, and I think they're important. But it's the rest of this stuff, the profit target and max loss, and I think that's probably the most important. And if you ask me the 2 most important steps, I would say step 2 and step 3. Whereas most people think it's this, adjustments or setup, and it's not. right? When to adjust is much more important than how you adjust. But anyways, this is the basic template that I've stuck with and that, was successful in the pits. But the bottom line is this was not being used out there. I mean, when I started, it was much more directional. They had some kind of stops when you would get out, but I think this non-directional setup, but it still allows flexibility that you can tweak butterflies or different strategies so that you have less risk on the upside, even though you're basically non-directional. And I think the, still pretty predominant in the educational business today, even if you go to like websites, CBOE or some of those, you'll hear a lot of, okay, let's start out with what's your opinion, right? And I'll be honest with you, I don't care about your opinion. I mean, I have opinions, right? I've got opinions about everything, but I think to be consistently successful at this, you have to, I just haven't seen many people that can be reliant on their opinion of where the market's going every week or month and be successful. Oh, again, I get it. We've been in a bull market for 5 years, so that's been a different situation. But anyways, here's the setup. And again, I'm not saying Optionetics or invest tools are bad. I just want you to get the impression there. But what I'm saying is when I came out of the pits, like I was in this community or building for 20-some years, and I come out and I say, okay, how are retail people being taught how to make money? And it was totally opposite, right, of what we taught and what we saw to be successful. Now, was there some risk management sprinkled in there? Yeah, but I think, was there some type of profit targets and stuff? Yeah, some of them there was. Did they talk about adjustments? Some, not that much. They talked about adjustments, but I didn't see a lot of clear profit targets and adjustments. But I think what killed the whole thing is it was a directional thing, right? Anyways, I just want to bring this up not to take the conversation and go down a back road and talk about good, but I'm just trying to focus on the process, the template, I think, of risk management that is going to make you successful, right? And overall. All right, so using the example I had, I'm just trying to give you, using this step 1, step 2, step 3, step 4, and the example for the put credit spread, using that to just give you an example of this process. So today's example, I gave a 37-day put credit spread. And so step 1, the setup, right? Are all put credit spreads start out the same? No, you can start it out however you want. But how I set it up in this particular example, which would be representative of how I would do a put credit spread, but sometimes I would do different with, would be vehicle SPX. So now we're talking the setup. Setup means setup. How do I initiate the spread? How do I set it up at the beginning? So vehicle SPX. Put strike to sell, about a 20 delta. Put strike to buy, 5 points further out of the money. Duration, 37 days, right? Width of credit spread, 5 wide. Capital for one contract, about $450, right? In this particular example, I got 60-cent credit, and I'm just putting a minimum. I wouldn't do it for under 50 cents. So these are things at the setup, the origination of the trade, that I would need to know, right? Some basic, and with us, the setup for a butterfly, or the setup for a credit spread, or the setup for a calendar, or the setup for an iron condor, the setup gets tweaked a little bit based on levels of VIX and levels of the SPX, just general levels. We're going to tweak it a little bit with the Greeks. But the other steps don't really change. To me, those are the foundations of the process. Step 2, profit target and max loss. Again, I'm for the credit spread example here, I'm keeping it very simple. I'm not getting into adjustments. I'll get into adjustments a little bit with the butterfly. So, but I want to talk about this template. Profit target, 9 to 10% of margin or risk. So in this example, I would have an order in to buy the spread for 20-cent debit. So again, in our example, I sold the credit spread for 60 cents. It was a 5-point spread. So the capital for one contract, and you could just multiply it if you do more than one, was $440. So if I'm trying to make 9 or 10% of 440, right, that'd be about $40, right, for every one contract. So if I, in this example, if the 5-point put credit spread was 60 cents, I buy it back for 20, I'd be making 9 or 10%. Okay, so if I sold it for 60-cent credit, I'd have an order in to buy it back for 20-cent debit, right? So that would be the profit target. Question says that's applicable here, do you check open interest for the strikes? I don't, right? You say, Dan, why don't you check open interest for the strikes? Here's my answer. As long as I'm in, we mainly do SPX or RUT, or, you know, again, SPY is fine, but we do a little more of SPX and RUT, and very liquid stocks, only your most liquid stocks, your Amazons, your Apples, those types. So as long as I'm in an extremely liquid vehicle, I don't care that one of the strikes is lower open interest. I've never saw that that's, over a long period of time, I've never seen that that's a problem. Now, could some of you say, Dan, you know, I've seen where it's a problem. Again, my answer is I've been trading SPX for 30 years, or since it started, whatever year that was. And our community's been trading actively SPX or RUT for a long time. So I don't, overall, are there, you know, again, you could say instances for everything. I could make an argument that on Tuesdays at lunchtime, I don't get good fills. You know, you can come up with a lot of stuff, but I'm saying overall, I don't see it. So maximum loss, 15% of margin or risk. So it'll be a little higher on my margin or risk. In this example, when the credit that I sold for 60 cents exceeds $1.25, I'd exit. So how do I get that? Again, max loss is 15% of the margin or risk. 15% of 440 is going to give you about what? 15% of 440 would give you about 65 cents. So I add it to my credit. And so as I put here in this example, when the credit that I sold for 60 cents exceeds $1.25, I exit. Now, as I said, step 2 and step 3, well, step 2, in terms of priority, step 1, 2, 3, 4, step 2, the profit target and max loss, I think is the most important. If you're going to get into adjustments, step 3 would be next in priority, then the setup, then step 4. So step 3 in this example, when to adjust, not applicable here. So I'm just using, in this template, I'm using, hey, I'm going to put these credit spreads on, I'm going to automate it, I'm not going to adjust. I can do that. And so if I'm not going to adjust, if I'm just going to take it off when I get my profit or loss, step 3 or step 4 are mute. It doesn't matter. Now, have I taught plenty of credit spread, we'll call them system, or types of strategies with credit spreads? We've talked adjustments. Yeah, so then I would have something for step 3 and 4. But again, profit target and max loss are still the most important, right? Adjustments are never negating this. Adjustments are just saying, if I haven't hit my max loss and I want to try to fix it or reduce my delta exposure, I can try to fix it and stay in the trade long enough for it to work. But I think some people think that adjustments gives you a license to ignore when you get out, right? And again, you can place, if I have an order and to buy it for 20 cents debit for a profit, I can still have an order linked by something called an OCO, one cancels the other, to buy it back if it gets to $1.25. So those are important, but not as crucial as the process, right? But it's just saying, again, you have to be responsible and have orders in place when to get out. All right, so, and let's go through one more strategy, and then I'll let you go, applying the process, right? So here's one example. Again, we have many different versions of a butterfly. That would be many different setups, but that's not the significant part, right? I mean, as I said, in a little more neutral to bullish environment the last 3-4 years, we're going to be a little more neutral on our position Greeks, especially delta, as the market is neutral to bullish. As the market backs off a little bit, we're just going to lean. So we're tweaking the Greeks a little bit, right? But let me just give you one of 3 or 4 butterfly methodologies that we've come up with that have been, we would call setups, right? That have been very successful over the last 3-4 years, and this would be one of them. But you're going to look at the setup and you're going to understand very clearly why it probably was successful, right? This isn't rocket science, right? So if you look at, here's an example today, SPX at 2470, and this is the VIX level today, 12. Today's August 16th, and this is the price of the underlying, 2417. Now, one thing before I even tell you what I'm doing here, what do you notice with the graph? This is the expiration graph. What do you notice with the expiration graph? So this is the expiration graph, or what the graph looks like at SEP 22 expiration in 37 days. So even though I'm starting it out relatively close to neutral, delta, for every 1 by 2 by 1, if I'm within a couple deltas of 0, either -2 or +2, I consider that pretty close to 0. But what do you notice here? That setup, we're calling this setup. But what do you notice with the setup that would be conducive to the upside? So what's conducive? So once I'm done with this, I'll answer some questions, a little more questions, but dramatically, it has more risk on the down. So even though this is a neutral, right? Again, this is your graph at expiration. This is your graph today that I'm putting it on, and every day you'd have a T, we'll call this a T+0 graph. In other words, this is how the graph looks today. This is how the graph looks at expiration. But you can see the purple line is how it looks today, which if the price of the underlying is here, it's kind of smooth relatively. Again, much less risk on the upside. So it's easy to manage on the upside. One adjustment to the upside, and if this is the 0 line, I can reduce, I'm going to show you one adjustment that, basically will take your risk to here. So they're very, we'll call this at the SPX, at the money, broken wing, or mango is just a term in our community we use that was come up with one of our mentors, Jay Bailey. It was really, the mango is more, not as much the setup, but this is the setup, but it was more some of the risk management on the upside. And I'll show you one of the adjustments. But if you look at it, broken wing, So it's at the money, and I like to put things at the money. You get the most theta there, but again, whether you put it out of the money, it doesn't matter. I mean, it's just a setup. That's not the crucial thing with this. That's broken wing because if you look at the short strike, this is all calls. I'm setting it up, selling two 24.70 calls, and then I'm buying an in-the-money call 40 points lower. So the width from the short call to the in-the-money call is 40. The width between the short call and the out-of-the-money call is 30. So anytime it's not balanced, that one of the strikes is further away or closer away than the other one relative to the short strike, you can use this term broken wing. The other thing, again, I'm considering, without getting into a lot, because again, I could turn what should be a short session today into a long one by getting into, you know, what's neutral deltas, right? Again, people could say, well, Dan, neutral means zero. Well, again, when I'm analyzing a trade, there's two major risks, price risk and volatility risk. So as a trader, I need to look at, just as a pilot looks at many different controls on the control panel, deltas aren't the only thing. I've got to look at vega and deltas. So based on their relationship and the relationship with the price levels of the market and volatility, I may want to be, you know, a little shorter deltas against my short vega. That's what I want to be, and that would be more neutral to me. So it's not as clear, you know, what I'm saying is that there's not just price risk. If we only have price risk and no volatility risk, yeah, zero deltas means zero deltas. But when you're looking at, when there's two factors that severely impact these things, volatility and price, you got to look at both. But anyways, so this type of strategy, this setup, what I'm going over today, has been very successful over the last 3 years, right? Extremely successful, right? And many students have been doing this and making good money year after year with this. And part of it is having it structured relatively, so non-directional. The setup is relatively non-directional, but we're just tweaking it a little bit based on the price levels. We've always been, you know, going up, and volatility has been very low, very conducive for the upside. So this is the example I'm going to use today. This particular example, and we do different versions of this, was 40-30. So the difference between the in-the-money call and the short call is 40. The difference between the at-the-money call and the out-of-the-money call is 30. So I'd call this width 40-30. The width of the butterfly on the downside would be 40. The upside would be 30. But again, it's the Greeks that are important to me at the setup, right? Just like you're a pilot in the cockpit of the airplane, it's the stinking control panel, right? You ever see those pilots go through their checklist, right? They go through their checklist, and it's very methodical. That's how we do it, right? We look at, okay, the SPX is what today? 20 points from the all-time high in the history of the United States of America. Agree? The VIX is at 12. We've been lower, but based on the volatility, based on the price levels, once I get in the cockpit of my Boeing 757 butterfly, how do I want my Greeks? How am I comfortable, right? So am I still going to apply the four-step process? Yes. Is the four-step process going to change all the time? No. The only step in the four-step process, the one that's going to be tweaked the most would be, I think, step one, the setup, right? How do I want to tweak my Greeks, right? When the VIX is 9, right? When the VIX is 9 and we're at all-time highs in the SPX, do I want to be just a 10 shorter deltas instead of 1 to 2 deltas short per contract, maybe 3 or 4 deltas short per contract based on the volatility? How about when the VIX was 16, right? When the VIX was 16 last Thursday, Did anybody notice that if they put on an income trade on that Thursday and the market went up the next day or whatever, 20 points, what did you notice? What did you notice? If you did a butterfly or whatever, what did you notice? Hey, the volatility really benefited me, right? And hey, I didn't lose much, or I made money from the volatility. So anyway, so here's the butterfly example I'm using, which is a 37-day butterfly. My width is 40/30. I'm doing it all calls. I'm doing it in SPX. So the debit is about $13.50 for one contract. So it's $1,350. If I narrow the strikes, I could pay less, right? If I were to do this in SPY, I could even pay less. So now let's go to apply the process. So step one, the setup. Setup, SPX, duration about 37 days, calls or puts, I'm using all calls, short strike, sell at the money, long strike, buy in the money, call 40 points lower than the short strike and buy out of the money call 30 points higher than the short strike. And because it's all calls, it's a debit transaction. Another word for the setup could be, what are the particulars that I'm comfortable with? And this will lead to, what are the Greeks I'm comfortable based on the levels of VIX today that are 12, and based on an SPX that's about 20 points from the all-time high in the history of the United States of America, right? And this is a setup. So I'm starting out about 2 delta short for every one contract. So if I did 10 butterflies, it'd be 20 delta short. So this is the setup. And then I get into, we'll be done here in a second, again, I'm illustrating this template that I've used basically my whole trading career, right? And again, the flexibility, a lot of students have, a little more, you can tweak the setup at the beginning. How do you want to do it? How wide the difference is with the butterfly? Do you go out of the money or in the money? But it's really, that's not the most important. It still comes into the, how do you handle these? Profit target, max loss, and some of the adjustments. So step 2, profit target and max loss. Profit target, 10%. In this example, I paid $13.50 debit and would take it off for a $14.85 credit. Simply, if this is the capital, $1,350, 10% of that would be about $135. So if I have an order in to sell it for a $14.85 credit, that's the profit target. I'm also concerned about the max loss, and I'll give myself a little more room with the max loss. In this example, I paid $13.50 debit. When the price of the butterfly hits $11.90 and the price of SPX hits or exceeds the expiration break-even point, I take off the spread for a loss. What does that mean? So 12% loss, again, it's not off in this case, it would be off the debit, but it's the, what's the cost of this trade? But it's the risk, right? It's the risk, and in this case, the debit and the risk are the same, about $1,350. So 12% of this, right, would give you about $160. So when the debit decreases, hits around $11.90, and, right, if this is the butterfly, right, expiration break even is just when does, at expiration, when does the graph start hitting the 0 line, right? So what I'm saying is for a max loss, I need 2 factors. I need this $13.50 debit to hit $11.90, and I need to be here. You say, Dan, what do you mean? Well, if I'm in the middle of the graph and I get a bad price in the SPX and it hits $11.90, should I get out? Should I get out? In other words, sometimes you get bad prices or the mid prices can change a lot, right? So what I'm telling you is not only I want a confirmation, right? Just like if you're at home and Jeff Richardson sees he's got the smoke detector, before he's going to have his family go outside, not only does he need the siren to go off in the house, but he needs a confirmation. What's that confirmation? Smoke. I need to smell smoke somewhere. So not only does my 1350 debit have to hit 1190, I need confirmation. We need to be, the price needs to be where it usually is when I start getting in trouble. If it's in the middle, then it's like I'm at home and the battery smoke, our smoke detector goes off every night lately. Did you know that? Every night when my wife or my son is cooking and it gets too hot in there, I don't know what it triggers the goofy smoke alarm. I don't know if that happens with you guys. And so we got to go up and reset, press that little button, and it goes off, and maybe we need to change the batteries. So, but again, these numbers, these are the most important things. This is where most of you run into trouble, right? When you get to a max loss, you don't get out, right? Why don't you get out? Because none of us like to lose. SPX Butterfly Guidelines, Step 3, when to look to adjust. So let's say, again, I'm not ignoring my max loss and profit target. Okay, when are some points I'm going to look to adjust? And I put upside 5 points above expiration break even, downside 5 points below expiration break even. So if you look at this, so we're step 3 in the risk management process. Step 3, when to adjust. So what am I saying? I'm saying expiration break even is when the expiration graph at break even, when it starts right here, starts going under 0. These points, right? So 5 points above this on the upside is where I'd be looking at the possibility of adjusting, and 5 points before this on the downside. So I'm giving you some when targets you'd be going into the bad neighborhood and getting in a little bit of trouble, right? So I'm giving you some guidelines when to do that. And then number 4 would be on this would be, okay, if I am going to adjust, how do I adjust? And I'm going to give you one that's pretty popular, how we use. On the upside, I just said narrow the upside by buying a call vertical. In this example, let me just, so I don't have to keep flipping back, let me just go back here. So in this example, folks, I'll be done here just in a few minutes. But I wanted to give you a thorough, this is the process we use. And again, I haven't changed this. I've been mentoring about 15 years. I haven't changed this process, right? You say, why? Because it works, right? The only thing we spend some time on, and where a lot of students have, where we've, to me, where there's some flexibility to tweak, is the setup. You agree? The setup. You know, I want to do 40 wide, or I think this is the cat's meow, doing 30 wide, 40 wide. I want out of the money. I want at the money. But that's just, you know, that's a little individuality, right? It really isn't, to me, the key. The key is the overall template. And then some people will, hey, I like, you know, because the market's been going up, I like this adjustment better, but there's really only 3 adjustments anyways, right? Right? It's just knowing how to use them. What are 3 adjustments on most of these strategies on the upside and 3 on the downside? On the upside, any adjustment, I'm saying the most popular adjustments. I mean, you could come up with a million of them, but on the upside, you're going to buy a call, you're going to buy a vertical, or you might add increase your size or something. And same thing on the downside, right? Now, depending if you're doing all puts or calls, but you're using some type of a long option, some type of vertical trade, or you're adding some, right? There's not that many different adjustments you can do. All right, so here's, just so we can have this up in the, so you can see the strikes as we talk about the adjustments, just so you can see the strikes so you can visualize it. Here were the strikes of the spread, 24.30, Now, this particular example is all calls. Now, let me just say this real quick. Most of you know this, but I just want to make it quick. Whether you do all calls or all put butterflies for a debit, or whether you do iron butterflies for credit, to me, it's the choice of, do you like vanilla, chocolate, or strawberry ice cream? I don't care, right? If you think one of them's better, you're wrong, but go ahead and use one, right? You're innocently wrong, right? It doesn't matter. So why do I use all calls? I'm used to using all calls, right? If you forced me to use all puts, I do some all puts, that's fine. If you force me to use iron butterflies, that's fine. You know, whatever. I just use all calls. So upside adjustment. So again, we have the setup. We have the profit target and the max loss. We have when to adjust. Now we have how to adjust. So on the upside, one way, again, just giving you one here, you can narrow the upside by buying a call vertical in this example, buying the 2490, 2500, or 2495, 2500 call vertical. So which one should I use? Whichever one reduces my position deltas probably half to 2/3, right? But your upside, the width here is 30, and all I'm doing in both of these instances is rolling down the highest strike long call to narrow the upside width of the butterfly. So these two examples, that's all I'm doing is selling out the 2500, and in one instance buying the 2490s, another instance 2495. So very easy just buying a call vertical. On the downside, I'd narrow the downside by selling a call vertical. So if I'm doing the downside, which is 40 wide, on the downside, I'm going to be playing with the lowest strike long call, and I'm going to be rolling that up. So I either sell the 2440, 2430 call vertical, or sell the 2435, 2430 call vertical. So let me just spell this out. What does this mean? Sell the 2440, 2430 call vertical. It means that this is my trade. My adjustment on the downside would be buy one, if I do this one, buy one, sell one. Buy one, 2440, sell one, 2430. What's that called? Call vertical. What does it do? Lower the downside. How does it lower the downside? Instead of being long the 2430s, now I'm going to be long the 2440s. So now the width of the downside goes from 40 to 30, so I have less risk getting the downside. So anyways, I gave you a mouthful today, folks. I wanted to explain the template I've been using for 30 years and 15 years in the retail realm, and we haven't changed it. The only thing that's changed is a little bit of dressing up the cone, right? And that's where a lot of individual LAF students like to express themselves, and you can, you know, whether I do the butterfly this width or that width, whether puts or calls, whether I do it out of the money or at the money, but that's just, and that's a lot of just, basically it's tweaking the position Greeks based on what's going on in the market, you know, but it's the other steps of it that will prove long-term success. But a couple questions: what would your profit expectations be, if any, after adjusting? So generally, as a general guideline, without getting into a whole thing, if my profit expectations were 10%, once I adjust, because again, think about it, if I have to adjust, is the market going my way? Yes or no? If I have to adjust or fix a trade, is the market going my way? If I have to adjust, is the market going my way? Yes or no? No. No. So if I have to adjust, the question says, what would your profit expectations be, if any, after adjusting? As a general guideline, I'd lower them 30%. So if my profit target's 10%, once I have an adjustment, I would lower my profit targets to maybe 7%. As a general guideline. All right. If you need any more clarification, any other question, you can email me, dan@sheridanmentoring.com. Another question says, what is your average trade duration in days? What is your average trade duration? Now, again, your average trade duration is going to be determined by what's the original duration of the trade. For example, if I'm doing a 10-day calendar or a 15-day butterfly, my average trade duration in the trade might be 2 or 3 days. If I'm doing a 50 or 60-day, if I'm doing a 50-day butterfly or a 50-day iron condor, my average trade duration in days might be 21. So your average trade duration in days is going to be determined by what's the duration of your trade. The shorter the duration, the less you'll be in the trade. The longer the duration, the longer you'll be in the trade. Next question says, if you're expecting a market to correct, would you wait on a mango or an unbalanced butterfly like the example I gave you today, or make it more below the money to start? All right, let me make a good question. So if I'm expecting the market to correct, and I would imagine that's a down move, would you wait on a butter mango? We called an at the money broken wing butterfly, like I said today. So the question says, would you wait to put that trade on, or would you make it more below the money to start? So I think what SSKK, that's quite a name, is saying is, should he start the short strike more out of the money? And my answer is no. No, I wouldn't wait. And again, making your short strike more out of the money on the put side doesn't make it more bearish. Again, it's all your Greeks, right? Right? Remember, if you're selling an out of the money put but 50 days out, what the heck does that have to do with anything? If the market goes down a week or two into it, you're going to get, you could get hurt. So it's really, if I'm expecting the market to correct, would I wait on a mango? No. But would I make it, instead of maybe 2 deltas short, maybe 4 deltas short when I'm starting? Yes. So that's what I would do. All right, another question says, I think I missed the when on doing the adjustment versus taking a loss. If you go back, Wallace, over we'll just take the butterfly guidelines. Step 2, we give a max loss, right? So anytime we hit a max loss, we get out, period. When doing the adjustment was 5 points above the expiration break even on the upside and 5 points before it on the downside. So again, let me make this clear. I want to say this in Spanish, English, and a little Somalian. The minute you hit the max loss, you're out, right? So I never can say at a loss, I'm at a max loss, I'm going to do an adjustment. No. No way, Jose. All right, another question says, do you do this butterfly only on the SPX? What other products or index can you use it on? You could use it on RUT. You could use it on very liquid stocks. You can use it on SPY. And they may be, the setup may be a little bit differently because it's not the same product, right? The widths could be a little bit differently and stuff like that. Eric says, do you suggest waiting a day for confirmation before adjusting if break-evens are hit? Again, I gave in my guidelines today, I said, I think I mentioned, if the break-evens are hit and I'm down X amount of money, that to me is enough confirmation. Again, I get what you're saying. Eric's saying, good point. You should wait a day for confirmation, like in technicals, wait a day. You could, but again, when I'm running a business, I've got to somehow, how do I work? Technicals are a good tool, but I can't let the technicals run my business, right? The technicals are a tool, it's a guide. And so I generally don't wait a day, because if I'm in trouble, you know, the next day could get me in a lot of trouble. And the problem is I don't ever want to lose in a week. You know, if I'm making $500 every week, I got to keep my losers under control, right? So if I lose in a losing week more than, you know, much more than 500, what if I lose 2,000? That's going to bother me. It's going to take me 4 weeks to get it back. So I got to be careful on my gambling. So not that you know, again, are there instances where I might wait a day? Yeah, but I just don't. I can't get into it. You know, it depends on what my adjustment would be. If I had a long call or put, that might buy me some time, but that might, but for sake of discussion, I'll just stay with what I said. Don, you could just check the guidelines that I gave you on the slides as far as when to adjust. It's all there, right? If you can just go, you know, on the butterfly, it was 5 points above the break even. On the downside, 5 points before. So you could, what I would do is just look at the guide. You know, I wrote it all out there, kind of review it, and then if you have some questions, do you offer any options on commodity futures? Again, you can apply the same principles that we teach. We have some students that, and even Mark Fenton, one of the mentors, trades oil options and E-minis and oil E-minis. I think there's one other one. So most of the strategies we apply, with the exception of calendars, you can apply pretty easily with those. Can I cover portfolio hedging suggestions in the third session? I'll consider it. Let me just see some of the other topics I was thinking about, but I will consider that. Appreciate it, Eric. Do you use bracket orders for targets? Yeah, bracket orders would, I'm not sure what you mean by bracket orders, but I might put in, you know, either get me out at my profit target or max loss, whichever comes first. And then if I get, let's say I get hit on my profit target, it will can my max loss. Let's see here. Do you record these sessions? Yes, they will be available for review, I think, on YouTube. I'm not sure exactly when they will be posted, probably sometime today. And, or Johnny answered that. So anyways, thank you, folks. I appreciate it. Come back next Wednesday. We will have another session, and I look forward to talking to you next Wednesday. Thanks, Dane. Thanks, everybody. And we will see you next week. Have a great day. Thanks.